welcome. And to our audience here, thank you for coming. So we're not talking to the air. Welcome to the deep dive into post-pandemic CRE market with Jim Costello.
Thank you.
This event is hosted by Sandstone and Acres, so thank you to our host. I'm Luo Wei. I'm your moderator today. I work at CBRE. So over the last few years, I've had the privilege of knowing Jim, and I've listened to him many times. I can tell you we have a great speaker here today. He is one of the best economists and thought leaders and speakers in the industry. And he will give us a presentation today, and it will be followed by Q&A. So for our viewers on YouTube, please share your questions in the comments section as I can see them. And for our audience here today, please prepare your questions as Jim loves those. And for the presentation today, Jim will talk about post-pandemic capital markets from investment and pricing perspective. Without further ado, I'll give the floor to Jim.
Thank you so much. Thanks for being here today with me to talk this through. This is interesting. This is the first event that I've been at where there's live people. It's not back to normal. There's more people online than in the room. But for the folks in the room, thank you for being here. It's great to see some actual faces again, as opposed to just talking into a box in my apartment in Brooklyn. For my talk today, really the topics I want to get into is what we should be expecting as we move from this recovery period into the next stage of the cycle, which is an economic expansion. We're not through the pandemic yet, but we're through some of the worst effects of it. We're through the recession at this point. We are through a lot of the worst parts of it, but all the pain isn't done yet. The nature of the pain and what happens next is an important topic as well, because that has something to say about the types of investments people are pursuing and the opportunity sets that people can find moving ahead. There's a lot of people who are hoping for massive distress, and it's just not going to happen in quite the same way. So I want to talk first just some terminology stuff around recovery to expansion and what I mean by that. So we've got sort of just a generic chart here. There's no real data. It's just an indicator of the market cycle and what we mean by different terms. The market goes up, and this could be deal volume, this could be prices, this could be anything on this chart. You get to some sort of peak, and then there's a crash. The market rebounds once it's no longer declining. It still might be lower than the previous peak, but it's already on the way back. There's still something happening there. And that's sort of that what I call the rebounding phase. Recovery means just kind of getting back to the pre-shock averages. We think about like where we were in that 2015 to 2019 Goldilocks period when we didn't know that we'd have to wear masks and we couldn't go to bars and restaurants and stuff. What does it look like getting back to that level? And when we're back at that level, I'm calling that recovery. But beyond that, at some point, we're through the economic shocks, we're through the heartache and pain of the recession, and then we move on to the next stage, which is that economic expansion. And I bring this up because we are at a different stage for every property type. There are different trends in place, and it's important to think about sort of this recovery, expansion, rebounding kind of phase. Every sector is different right now. So into the second quarter, we are more or less into what you might think of as a recovery phase. Deal volume is up. It grew at a triple-digit rate on a year-over-year basis. And a triple-digit rate, that's not sustainable. You just can't keep growing like that every period. What happens is just the rebound from the second quarter of 2020, which was just so terrible. We've had that rebound and the triple-digit rates is just a function of just how bad it was last year. Nonetheless, if we look at sort of the averages, from 2015 to 2019, we had about 127 billion in sales activity for every second quarter. So we are now, I'm calling it in a recovery phase. I'm not saying that's a new expansion yet for a couple of reasons. One, it's not going to every property sector. Also, there's some measurement error in there, and you're not exactly measurably different than everything in those previous periods. We're close, and it's definitely a good sign. It's definitely a good sign relative to where we were last year. Along with all this activity, given the nature of the organization, the American Chinese Real Estate Society, I want to talk a little bit about the New York area, because there's a number of New York members associated with the organization. Plus, there are a number of folks tied to capital sources coming from outside the United States here. So cross-border money as a share of the total, it actually increased in the second quarter relative to the past, but in line with every other type of capital source. But as a share of total transaction volume, cross-border money fell into the second quarter. It's really a question of the cross-border money didn't grow and recover as much over the last year as did domestic capital sources. And I'll get into that in a bit, but I think it's mostly a story of the types of deals that these different investors pursue and the types of sectors. If you look at the top countries for the cross-border money over the last 12 months, there's been a bit of a pullback from the leaders in recent periods. In recent periods, it was Canadian and South Korean investors that were in the lead. They still are in the lead, but they're not accelerating at this point. They're pulling back a little bit from the pace they've set over the previous 4 quarters. Interesting moves out of some stuff in the Middle East. Saudi Arabian money, mostly from one fund, is up dramatically. But it's still largely some of the same players. Chinese investors, that is a little bit interesting. You're up from a year ago for that activity. That's the first time we've seen that kind of an increase relative to the periods when there was a flood of Chinese capital come to the United States from 2015 on. There are a whole bunch of folks here in New York that I met when I first moved here who had come in from China with that wave of optimism as capital was flowing out. There was some imposition of capital controls and Chinese money fell back in the pack. But it's interesting how it's almost as if it's not quite at the bottom, but sort of stabilizing at some point. So back to the property market broadly, and I'm looking here at a table of just deal volume by property sector. And there's some funny movements here. The industrial sector is one of the most popular sector for many investors right now. Everybody seems to understand the notion that with some dislocation in the way consumer shopping is happening to move more online, that you'd rather own the warehouse where the goods are stored rather than a retail facility. Sales there were only up 10% year over year for the first half of the year. But that's not a sign of a bad 2021. In fact, 2021, we are at record levels of industrial sales volume. We have moved beyond recovery into an expansion phase for industrial. But part of the story there is just what happened the year before. Prologis was on a tear and bought 2 companies just before the pandemic started. That was a smart move on their part. But that kind of colors the change there. The thing that I saw in the numbers that I'm finding kind of interesting is that we have a recovery everywhere. There's an expansion activity everywhere relative to 2020. And that makes sense because in 2020 it was hard to get anything done anywhere when everybody was stuck on their couches. But the major metros, so this is New York, Boston, DC, Chicago, San Francisco, LA, largely these expensive coastal markets, these areas are having more trouble than others. We're only up for the first half of the year 13% from a year ago. So that is a sign that there's still some concern that investors have about these areas. And you can see it in the numbers for the office sector. The office sector in particular has always been very popular in these expensive coastal markets. And it's only up 6%, versus, say, hotel, which is up dramatically in triple-digit rates. So there's a shift in terms of the sectors that are growing. With the apartment and the industrial sectors, those are the 2 leading sectors for deal activity. And those are the 2 that I think are a little bit more interesting for everybody. And I'm looking here just the levels relative to the pandemic. Apartments are up, 43%, industrial up 63%. Those are clearly in that expansion phase. We have, in those sectors, shaken off the problems of the pandemic and reaching to new heights in deal activity. If you're a young broker right now, that's the place to be. It is a different story when we look at office and when we look at retail, those are the sectors that face some of the most questions about what happens to disruptive influences moving forward. I'm not saying that they are going to be disrupted moving forward. I'm just saying that there are questions around it. And because there are questions, there's not a meeting of the minds between buyers and sellers in terms of what happens next for investment activity. And so those are sectors where we're going to have just a little bit more of a challenge in the near term. Now, other property sectors are also of interest to investors right now. There's a hunt for yield worldwide, and investors are looking at so-called alternative real estate, things like self-storage, senior housing and care, student housing. In the first half of the year, though, it seems to me that most of the activity is really tied up in the life sciences. We've got it, we don't have the life sciences broken into the discrete performance for the properties themselves. We're looking at just the broader R&D universe as a proxy for where the life sciences are going. But as a share of total commercial real estate investment, it's seen the biggest increase of any of these alternative real estate subtypes in the last year. I mean, it had been 2% in the first half of 2020. It's now 4% of activity for the first half of 2021. Life sciences, there's just a growing interest in that sector and what happens next there. And it makes sense. You look at the pandemic and you look at what's been spent on new vaccines, new treatments. Everybody understands the value there. There's more of a meeting of minds between buyers and sellers understanding what the value proposition is of those assets and those tenancies. There's some sense that they still need to be there moving forward. So, and there's money and growth in those sectors. So there's going to be some performance coming out of those properties as well. Now, kind of a high-level view of some of the different sectors, but I'm going to do a bit of a dive into individual property sectors. Not every property sector, just a few that are of the most interest to people I've been talking with. And then I'm going to get a little bit more into some trends on just pricing in the U.S. and also a little bit of a perspective globally as well, just to help with some comparison purposes. So I'm going to start with office investment. And right now, it's becoming a suburban investment story. Traditionally, the office sector was kind of split in the United States between the suburban office market and the CBD office market, all transacting in equal shares of activity. That's changed, but the funny thing is, it was changing even before the pandemic. Into Q2, we saw that $19 billion in deal activity was seen in the suburban markets versus only $7 billion in the CBD markets. Before the pandemic, it was a little bit more weighted to the suburban areas because in that pre-pandemic period, we had a few challenges. We're going to pause for a second here. We're having a little bit of technical trouble. Oh, no worries.
We have received a few questions, but
oh, good.
You're answering them along the way, so
well,
doing well.
You can. Whoops.
Oh yeah, it wasn't a full screen earlier.
Oh. So everyone was seeing the PowerPoints as opposed to seeing this. Okay, I get it.
It's okay.
Yeah, I covered myself up so I can see and not see what I'm saying, so I don't get confused. That's to me that's been my secret in all my online stuff in the last year. I just don't look at myself. I just talk, that's why I like a live audience more. I can just see what the people here are thinking. So in any case, suburban offices. There was, even before the pandemic, a little bit of a move towards more investment in suburban offices. Demographically, it made sense that you'd start to see a little bit more of a move towards investment in suburbs because the labor force was naturally inclined to start moving to the suburbs. There's a big story throughout the early stages of the pandemics. Everyone's abandoning the cities. Everyone's trying to buy a house in the suburbs. That was destined to happen. Demographics made that the case. The millennials are not young anymore. I mean, to me, they're young, but they're in their 30s. It's time for them to settle down, have kids, pair off, and move to the suburbs. That's a part of the natural part of the life cycle they were all in. even before the pandemic hit. And the pandemic had nothing to do with that. They were naturally going to start moving to the suburbs. And if I am an employer looking for office workers, I want to make it easy for them to get to someplace where they're working. So that we were kind of scaled at the time to have a tremendous growth in suburban office markets just because the labor force was moving that way. That's an open question. Do they need those suburban offices now? That's something that everyone's got to raise questions about. But nonetheless, before the pandemic, that was the move. And now that we're not done with the pandemic, but we're done with the recession, but the suburban market has come back more quickly. Some of this rebound is coming from the locations. More deal activity now is not focused on the 6 major metros, which are more of that urban CBD type space anyway. And more of it is in the areas with fewer restrictions on movement, areas like Dallas, Atlanta, Florida, markets in the South that are just naturally more car-friendly. And it has implications for pricing. If we look at our commercial property price index by property type, by office subtype, we have a divergence. With the CBD office market, it is showing a decline in prices versus the suburban markets. Prices are climbing. They were reaching up to 10% per year into the second quarter. Looking at some preliminary figures, it looks like it's accelerating even more into July. There is still investor interest in these areas. That is, and it's part of it is that these areas didn't shut down as much. Again, the risk-return trade-off that individual workers make, thinking about the risks they undertake commuting into the office on a crowded train versus a car by themselves, there's less of a risk that they feel in that suburban office market. So there's been more of a recovery in those areas. How this plays out, there's still a lot of debate there. But it's had an impact on the office markets of Manhattan in particular. Manhattan is just dealing with a dry up in investment liquidity at the moment. The liquidity is a hard thing to measure. Because a lot of folks that talk about it and they think about it just in the sense of deal volume, but it's not just deal volume. If you are looking to sell an asset, in a highly liquid market, you can get the price you want because there's always somebody else sitting there on the sidelines waiting to jump in. So counting up the number of unique players in the market is important, but then the type of capital coming in is important as well. If you have deep-pocketed pension funds looking to buy assets versus local players who are just focused on managing yield, we've got a different kind of perspective in terms of the bidding profiles. So we've kind of indexed all that stuff together globally to come up with a consistent measure on liquidity across markets. And across the major business hubs globally, Manhattan is the one who has experienced the most pain through this downturn. If we look at the dark blue line at the top, that's our liquidity measure, and it was the most liquid market in 2018, 2019, during this period before everything got bad. And it has experienced the sharpest decline. It is not quite like the decline we saw in liquidity in Manhattan in the aftermath of the financial crisis, but it's nearly as bad. So, but it's the one market that's had this big negative reaction. We don't have this kind of a drop-off in liquidity in every market. Dallas is down a bit, and that's an important one to cite because Dallas is one of the leading markets, for office investment right now. It's only number 6 for the first half of 2021. Manhattan is still at number 3, but Dallas is growing, and it's one of those car-focused markets that investors are, workers are a little bit more comfortable in. But the top market for office investment was Boston, but there it's a different story. It's not people making bets on one building at a time in Boston. There's a whole bunch of medical office and life sciences type investment that gets categorized. Some of those assets got categorized in the office side. And Boston's good with that kind of stuff, with all the education and medical technology stuff up there. So Boston is at the top of that list. But there's 2 different types of blue in the deal volume there. There's a light blue, and that's that portfolio sales. There's a dark blue, individual property sales, investors underwriting one building at a time. And in those cases, we see that Manhattan was just a hair's breadth below Dallas. So Dallas was a little bit ahead there, and Dallas had growing deal volume for the first half of the year, as opposed to the 50% decline for Manhattan. So it's a contrast I think is interesting. So the industrial sector. Switch gears to everybody's favorite sector today. Again, everybody understands the move of retail activity from the shop space, from the floor space, to cyberspace. The clicks rather than bricks, and having to own being able to own the back end of the internet seems like a great strategy for a lot of folks. There's been tremendous interest in buying anything industrial related. For Q2 of 2021, we saw more deal activity in this Q2 than in any other Q2 period. We are on pace for a record year of sales for the industrial sector. And this is coming as well, again, one building at a time. There's three different shades of blue here. The darkest blue at the bottom is when investors are buying one building at a time. The bright blue in the middle, teal, I guess you could say, that is investors buying portfolios of buildings. And then the light blue at the top, that's an entity level. That's just one company buying another. And we can see, like early 2020, there was a big spike in those entity level deals. Those were two transactions, mostly just Prologis being on that buying tear before the pandemic. But what's interesting about this Q2 2021, there's nothing entity level driving that. It's not about one company driving this, one big purchase driving it. It happened just with people seeing one building at a time, thinking that the credit of the tenant, that the location, that all the characteristics that go into an investment made a lot of sense. And so to me, that's a more stable market that has stronger legs, because it's not one investor making a decision, it's thousands. And so there's a little bit more stability that way. Did I mess it up again?
Oh, you did.
Whoops, did I? I apologize, folks. The mouse is very sensitive, and I clicked in the wrong place.
We got some good questions.
Wow, I really screwed up there.
Yeah. Do you think we have time for one question?
Sure, yeah. Well,
I was a little surprised by the office liquidity chart where you see Dallas. Mm-hmm. It's like in the class of its own. It's like below average.
Right. Yeah. Well, it's so part of that is Dallas. It's a different kind of market, and the liquidity was structurally lower relative to history. And if you think about the types of investors that are there, there's a lot of big businesses. That DFW is actually my favorite airport in the United States.
Okay.
American Terminal D, it's the best. It's not the mayhem of LaGuardia, but it's really easy for businesses companies doing business across the United States. It's a great location to have that. It's great for corporate headquarters locations.
Exactly. To that point, we have an audience saying ACOM is relocating to Dallas from LA. So do you see Dallas continuing to be a strong market? Maybe stealing some the focus or the target power from New York or LA or San Francisco?
Corporate relocations are not a sign of health for a market, I think. I mean, it's good for a market. It's certainly, I'd rather have a company move into my city than a kick in the teeth. I mean, it's not a bad sign of confidence in that market, but it's a cost savings thing. Yeah. It's not a sign of a company looking for growth opportunities. It's a sign of a company trying to manage cost structure. So the fact that there's a move, it's them saying that I haven't got any other better business opportunities and growth ahead. So think about the tech world in like Silicon Valley. If I have a great idea, I'm going to invest in that. I'm going to invest in something that helps me, control the computer with my brain waves instead, so Charlie doesn't have to fix this the next time that I click on the wrong thing. That's the kind of thing that drives growth. It's not, you're not going to get growth by moving to a low-cost location. You're just going to manage your cost structure there. You're not going to manage the next best thing there. So that's sort of the difference. Now, it's a good thing for a place like Dallas, but it's lower liquidity, because you don't have the same kind of big assets that a lot of capital can move into at once. So you're not having, if you are a pension fund in the Middle East, you're going to have a hard time putting a lot of capital to work in Dallas because there aren't the assets that they can effectively buy, as opposed to a Manhattan. But they're not going to buy in Manhattan right now because they're not sure how it shakes out in terms of the demand for the tenants to continue leasing the space in a place like Manhattan.
On that, are there any markets these big pension funds, deep-pocketed institutional investors looking at right now?
The markets, really, the market that is getting the most attention is anything with life sciences. That's been a big story in the office market. And so that's getting more interest. That's why Boston was at the top. There's a few others in that office list that were at the top because of that exposure to that knowledge base. And it continues to be something where if I'm buying offices, if I'm making a call that I can buy offices and there's some stability in that moving forward, it's places where there's some sort of hook that keeps the labor force there. And where even if we get more of a flexible model and maybe there's a little less intense use of the space, there's still going to be some sort of use of the space. So let's see, we're on industrial. Hopefully okay, we're back here. So industrial sale activity. We're at a record high level. But there's other forms of industrial investment. If I can't buy it, I build it. And we are now at a record high level of industrial construction in the United States. Looking here at a chart showing from the Census Bureau, so we've got the whole thing, showing here the value put in place for new industrial buildings, and I'm plotting it against the price cycle. When prices rise, all other things equal, it's a sign to developers that I should be building. And so I'm highlighting that with cap rates. The gray line here is cap rates for existing industrial buildings. There's an orange line here as well, which is the cap rate for newly built assets, like a sale of something within a year or two of its construction. Here's what the cap rate is. And that has plummeted to a bigger spread relative to existing buildings during the last 5 years. What had been, at most a 50 basis point spread at times was almost 100 basis points. That was a strong signal to developers, even before the pandemic, that they should be building. And so you see that ramp up from 2015 to 2021. It was all about the fact that there was just a tremendous investor interest in the newest of the new. Part of it was, it was developers delivering the types of space that was needed for the modern logistics world, and there just wasn't a big supply of it. So, there was a bit of an acceleration in that sense. But it has been interesting. There's been a little bit of a leveling off recently in the spread between the two, almost as if, there's so much investor interest for anything industrial that they're just willing to jump in even for some older buildings. But I'm not worried, though, about this high construction. When people talk about investment in real estate, they're always worried about competition from new construction. Industrial is one sector, even though it's at a record high pace. I'm not worried about, say, the kind of fallout that we had in the late 80s, early 90s from all the excessive construction that happened then, in part because it is industrial. Industrial, you can shut off on a dime. It's not a giant office tower that once you get going, you have 2 years of construction and you have to continue, like the Titanic crashing into an iceberg. The industrial sector, it's tilt-up concrete construction. It's easy to shut down quickly. So once the signal comes through from the pricing and nobody's willing to pay up for the new stuff anymore, I think that supply stuff can start coming back down more quickly than any other property type. And we see that like in the 08 to 09 period when there's a clear signal. It did fall off kind of sharply. It wasn't a 2-year acceleration of supply like we saw in the 80s from the office sector. So top markets for industrial construction, or for industrial investment rather, it's a lot of the same players that we've always seen for the industrial market. LA and the Inland Empire are the leaders. Those are the two big logistics hubs in the United States as goods come in from China on the ships. On this chart, one thing I did that's a little bit different, you could see here, I mean, it did it for the office market. You just couldn't see it because there weren't any. The market names that are highlighted in orange are markets where, for the first half of 2021, we've hit a record level of deal volume. And top two on the list, LA and the Inland Empire, they are definitely on the top list. We've never seen as much activity in those markets. Other big global hubs were at that top too. Well, not just global, national, regional hubs. Houston, Atlanta, Miami, those are also some distribution hubs for parts of the United States. One other big one, the two big ones that didn't make that list, Dallas and Chicago. Those are two of the biggest distribution hubs in addition to the stuff out in LA and the Inland Empire. But they're not at the top of the list. It's not a story about Chicago and Dallas and some sort of worries. It's actually just a story about last year. There were two big entity-level deals in the first half of 2020 that drove a ton of deal volume when Prologis bought two different companies. A lot of that stuff was exposed to Chicago and Dallas, and it just made too high of a hurdle for those two markets to overcome in the year. So it's not a bad sign for those markets that they're down so much. It's not like a sign of worry on those two markets. They're still at some incredible high levels of deal activity. It's just, last year was even better. So I'm going to jump into the apartment sector now. And in the apartment sector, here too, we are above the pandemic levels for Q2 periods. In fact, we are at a record high for any Q2 period for the apartment sector. Again, breaking it up by the deal structure, whether it's the entity-level stuff, individual buildings, portfolios, and here too, it's folks making that one building at a time decision. It's not the mega deals driving activity, so it's built on a stronger base of investor interest. With that, we have. Is it necessarily a trend? If it continues, I think we're going to be. We will be on a record pace for the year. The first quarter wasn't as high as the first quarter of 2020, so there's still some concerns to be looking through there. Nonetheless, we're on a good pace for the year so far. Cap rates, we continue to see cap rate compression, but it's more focused so far in the year and for the pandemic on the garden segments. Now, I'm looking at the total apartment market here. That's the orange line. And then the light blue at the top, that's garden apartments, and then the mid-high-rise stuff is the darkest blue at the bottom. Now, the mid-high-rise stuff, it's kind of interesting. Again, a lot of folks talk about everything kind of pandemic, but there were things happening in the economy and the property markets before the pandemic that were having an influence that are still going to influence things as we come out of this. If you look at the dark blue line, look at the way cap rates were going up from 2019 to 2020 for the mid-high-rise space. What was happening in the expensive coastal markets where most of the mid-high-rise space is at, rents were growing at such a record pace that we had legislative efforts to introduce more rent control regulation. You had rents growing at an excessive rate because local government policies made apartment construction illegal in many cases. And so with limited supply, rents went up. And so the solution to government interference, of course, is then more government interference with new rent control regulations. But the cap rates, they did start to creep up because of uncertainty about how much more that will continue. And at the same time, capital started to redirect into the garden apartment buildings, particularly in the Sunbelt markets where there was a lighter touch on that regulatory review. A little bit more ease of construction, a little bit more ease of working with local government agencies to get stuff done. Nonetheless, throughout the year, everything saw cap rate compression. We've seen in that mid-high-rise segment where there were more concerns about the rent control regulation limiting the upside. We saw a little bit more, we're now at levels lower than we were before the pandemic and before the rent control regulation stuff started to come through. But the garden apartment stuff, it is now at levels that we've never been this low. There's that much investor interest for the sector. In terms of locations, it's, again, the Sun Belt. That's where there's more investor interest today. These are areas that, even if one doesn't believe the thought that everybody's going to leave LA and New York for Dallas just because it's cheaper, there's still reasons to be there. I like Florida, I like Texas, independent, of anything else. It's not as though one area of the country has to suffer for others to grow. It's not like, you're not robbing Peter to pay Paul. The whole pie is getting bigger. And demographic moves are helping those markets. Dallas has always been a major apartment market. You can look at the ranking we have on this chart of deal volume. In 2018, 2019, 2020, Dallas has always been at the top. There's a ton of garden apartment complexes in the Metroplex that, it's a very highly liquid market. There's a reason that our data partner, RealPage, a company they bought, Axiometrics, back in the day, it's the reason all that got started in Dallas. It is a huge apartment market, and the information kind of flowed from that nature of the market. Others that were at record high levels of deal activity, you look at the markets highlighted in orange. Again, it's all these markets in the Sun Belt locations. Those have been very popular of late. Now, one thing that I wanted to talk about, I was talking about individual property sectors, but I did have one thing to talk about. I know that within the ACRES group, there's a lot of folks involved in real estate development. And there's one sector that during the downturn did not perform right away like before. This downturn early on in 2020, there were a lot of bad takes. People thinking that, this would be just like the financial crisis because it's a recession. I think those bad takes were simply a function of just people not having lived through multiple recessions and seeing that everyone is different. But during the financial crisis, the first thing that broke was development site sales. Developers had land, they had no income coming in, they couldn't continue to pay the carrying costs of holding the land, so they had to sell at a loss. Not this time. Development sales actually continued throughout the crisis. And that happened because the developers, well, number one, they can still get debt. And if you give a developer money, they'll build. That's a truism. But then number two, people kind of understood that this is a temporary shock. This is not a permanent feature of the world that we all have to stay at home. At some point, there's a need to be out and about doing different things. Maybe we do things differently. Maybe we do things in different places. But the world gets back to normal at some point. So developers were willing to step up on that. Now, where they bought land changed. We see the sales of development sites are split here between sales in the 6 major metros and the non-major markets. And even before the crisis, we saw that within the 6 major metros, there was a downward trend on development site sales. Development site sales in the 6 major metros, that peaked in 2015. Again, that's when a lot of the Chinese money was coming into the United States, and a lot of the Chinese firms really had a construction bent. And everyone wanted to kind of take the business model that they had used building modern cities out of former swampland in places like Shanghai, and just put it to work in other parts of the world. So development site sales, continued to grow in that period. It's not to say that we're not at a bad level today, but we're certainly not back at that peak. The areas where development site sales throughout the crisis really continued to grow was in these non-major markets. That's where the development is more active. That's where the developers see the more income growth opportunities moving ahead, and that's where they've been a little bit more active. And again, likewise, in terms of what they're building, it mirrors in a large way the investment sales activity. If I'm going to be building something, I'm much more likely to be building the sector where everybody's jumping in trying to buy the buildings. I'm much less likely to try and build retail in a world where nobody's trying to buy retail today, or very few people trying to buy retail. So we see retail construction down 7%. Office is down more. Office was down 35% for the year. This is the value put in place of everything that we track in terms of new construction projects. And so just the value of what's coming into the market is a lot less now for offices than it had been in the past. Apartment is still the leader. It's down 3% from a year ago. Again, though, there's a shift. Part of that is there's more in those non-major markets, less in these expensive coastal markets, And so the value goes down because those assets are priced a little bit less as well. So pricing, that, I alluded to this, but I wanted to jump into it. And pricing, I'm looking here at the report, a chart from a report we released the other day. This recession was different than the last one. The last one, we see that globally, I'm showing here in the bright blue in the middle, that's our global commercial property price index for commercial property price trends globally. And we saw a decline into 2010 from the heights that we saw in the beginning of 2008. So a nice 2-year decline in prices. I've highlighted a couple markets here that I think are of interest, and then there's some gray lines just to kind of give you a sense of some of the other major 18 global markets that are out there. And you can see in that period of 2008 to 2010, there's a compression. Everybody kind of moved in the same pattern because there's one common global pattern that was impacting everybody, and it was a global constraint on debt and a global constraint on the liquidity of the market from debt. This time through, we have a different perspective. New York Metro, it's a dark blue at the bottom. We have started to see some price declines, not major declines, but some declines, kind of in line with that liquidity chart that was up there earlier. Other markets, it's not really the same. San Francisco, another big U.S. market, a big tech market, it stalled well before the pandemic. The growth stalled into around 2019. The story there was just we were at the long end of a cycle on the technology market. There had been this blitzscaling this blitzscaling business model that the tech firms have been pursuing of gaining scale before they try and gain market share. And that blew up with the WeWork blowing up. And when that IPO didn't happen quite as everybody planned, there was a bit of a retrenchment in that tech world where people realized that they couldn't just invest in things hoping to get big. They had to invest in things looking for income and yield and all the things that make property so great. So the capital was redirected at some point. And that's important for a market like San Francisco where so much of the activity was built off of just that growth in the tech sector. If that money was looking for something else, you just didn't have that upside growth anymore. Toronto, another big North American market, prices throughout the downturn, it just continued up. Again, capital flows matter. If I'm an office investment firm in Toronto and I can't hop on a plane and go look at assets in the United States, where else am I going to direct my money? Well, I'll direct a little bit more of it internally. And that has some implications for other global markets. Seoul, I have a chart on the next page that shows that. Another one I find kind of interesting myself, Hong Kong, prices had declined from the peaks in 2018 just because of all the turmoil that had been underway in the territory. But it has shaken off some of the challenges of COVID and is staging a bit of a rebound even after all that. So there's growth, but there's two things I take away from this. There's a different pattern everywhere, and it's not the same pattern that we saw during the financial crisis. There were other things at play. And here's kind of the same story, just a little bit of a different perspective, a slightly different measure we have, and I'm making a comparison between Manhattan and the office market and some markets in the Asia-Pacific region. And this one's different too because it's indexed to US dollars. There's some movements here that have to do with the dollar differences. But not all of them are moving in the same direction. Seoul, it's up tremendously because Seoul, there, especially the Koreans, they had a lot of money coming in. You don't have to take a picture of it. I can get you this slide stuff afterwards. That picture's going to look crappy, and it's a chart, you can use it easily. But so that growth in Seoul is just a function of capital being redirected. And in the previous chart, we don't have an index for Shanghai and Beijing in that previous chart. Just the methodology. Those aren't really trading markets yet. You have investors who built something and they're holding it. It's not the kind of market where there's a lot of sales relative to the size yet. It's just not the market in a sense, even though they're very ancient cities and they've been around forever, they're not big investment markets historically. And so it's going to take a while before they kind of get to that transaction side. But this other measure we have, looking at the changes in the quality of what sells, we've seen a lot of investment activity and price growth in a market like Shanghai. And this is different. Everybody in the early part of the downturn, was ringing warning bells. Oh, we're heading into recession. Prices are going to decline dramatically. Look what happens in the public markets. And early on, I was highlighting the fact that no, it should be different this time. And part of that is just my background. I've lived through now. This is my fourth recession I've lived through in my working career, and every one of them was different. And it's almost an evergreen story I write at this point that this recession is different than the last one, because the behavior I've seen is always that people look at the recession and they say, well, the last recession this happened, so it should probably happen again, without only looking at the lines in the chart, without looking at the fundamentals, what's happening in that downturn. You go back to 07 and 09, I'm looking here at the FTSE Nareit apartment index, sort of the price component of those publicly traded firms, versus the CPPI that we produce for the apartment sector, looking at those sale properties themselves. Sale properties themselves, it lagged the price changes from the downturn in the financial crisis. It makes sense. It takes a while for private sales to actually come through. Versus public markets can price immediately, and folks were concerned about the downturn, they sold off assets. And we see the same behavior from the public market side this time, a tremendous drop in public market property prices in 2020, and we never saw a big decline in apartment prices. And people were telling me, oh, your index is no good, you're not showing what's actually happening in the market. But it was, because it's measured from what's actually selling in the market. And investors were stepping up and buying buildings in the apartment market because they understood that there was still some income growth. There was a ton of capital looking for a home. They could get a loan very easily on a property. So there really wasn't a need that any seller had to sell something at a tremendous loss. You didn't have people over-leveraged as they were in the 07, as they had over-leveraged in the 04 to 07 period. So, asset prices didn't collapse because we didn't see the debt portion of the capital stack disappear. That was a distinction that made that last downturn so severe. Now, there's differences by, is that? Oh, question.
So do you think the collapse of price won't happen for this term? It happens last after 2008, but this time it will not happen, or you think it's going to happen at some point?
No, I don't think it happens. And then there's a couple of reasons. One, if you look on the chart here, if you look at the public market price, that argument that we're just due, we're going to follow the public markets eventually. Well, if that's the case, the public markets have already realized that things aren't collapsing, and we've seen a rebound in REIT share prices. So it's as if the market. I'm not saying it's irrational. I'm not saying the market had it wrong. I'm just saying that they were focused too much on the headline numbers as opposed to looking at the individual income characteristics of buildings. And when you look at the more granular level, it was clear that what was happening was sustainable. There's a lot of individual investors looking for a place to park capital and just wait. And you didn't have that kind of turmoil. And this is across every property type, where you see this rebound in the REIT share prices. So everybody kind of understands that we're not at that same situation as before. Now, there's a question: what happens with Delta? Does the Delta variant change this? Maybe we hit more of a challenging economic downturn moving ahead. Knock on wood, that doesn't happen. Hopefully, everybody figures out that let's be like Singapore and get up to 80% vaccination rates now, because dying is no fun. But I doubt we'll do that. There's still just this arrogant level of ignorance in some parts of the United States. But even with a little bit more pain on the fundamental side of the economy, maybe longer lockdowns in some cases, maybe some fall conferences shut down, hotels don't get as much activity. The fundamental reason the prices fell so much in the last downturn was about a change in the debt portion of the capital stack. There's nothing indicating that there's going to be a change soon in terms of debt market liquidity. I mean, what could happen? Let's say we did have a worst case scenario. That would be a much more virulent Zeta strain of COVID that gives us you grow horns. I don't know. It's much worse. And then combine that with maybe a level of tiredness from all the regulators and the lenders. Maybe the Fed says, you know what, it's just going to be, it's a constant now. We're just not going to provide any more support. I mean, they aren't providing the kind of support they were in the past. They're not buying mortgages anymore. They're not doing that. But they're signaling a willingness to step in and help. If they signal the willingness to just let the market be where it wants, that might change things. And if the regulators of the banks stepped in and said, no, we want you to tighten up. We want you to mark everything to the market using a worst case scenario. Combine all three of those at once, and yeah, you might see something bad happen. But it's not likely. In the near term, there is a sense that the regulators and the Fed have that they want more stability than anything, so they're not going to try to make anything worse. So it's not like the financial crisis where they just dithered for a bit while the debt markets disappeared. This time through, they acted much more quickly than before. The CARES Act in 2020, that went through so quickly. We spent how much money was that? How many trillion? Overnight almost. As opposed to during the financial crisis, there's a story of after weeks and weeks of turmoil in the stock market and in the public debt markets, Hank Paulson getting on his knees. If you've ever seen him, he is a giant man. He got on his knees in front of Speaker Pelosi, begging her to act because it was clear that there were problems in the market. And we didn't have to do this time through. This time through, there was a spike in corporate bond rates, and immediately the CARES Act passed, and so that signaled that there's not going to be that there is a backstop. The only way we get to that kind of price decline moving forward is if that backstop goes away. So by property type, again, there's a bit of a K-shape. The same sectors that have investor interest in the apartment sector, in the industrial sector, that's where property prices are growing more quickly. I'm showing here through mid-year, we have some initial data I was looking at for July. It's going to be even stronger for these sectors. There's some segments of the apartment sector that are going to be approaching a 15% year-over-year growth in prices. There is just a tremendous flow of capital into the apartment sector, but more of the Sun Belt locations, more of these smaller markets. There's sort of a shifting down of where that goes. But even into the office and some retail, there's some recovery in prices. It's not as bad as it had been. Again, it's all about the debt markets. Lender liquidity is better today. The one area, and so I'm showing that here, kind of like that liquidity index I showed earlier. It's just counting out the number of unique lenders. If I have a loan to get refinanced, I can go to 10 different potential lenders. I'm going to have an easier time making things happen than if there's only 5 people willing to make loans. And we have, so I've highlighted here the different property types, just counts of unique number of lenders and indexed it off to 100 to kind of give it a common trend. And the one sector where we've seen a fall off in that liquidity on the debt side is the hotel market. The hotel market, it's faced more challenges than anything else. But again, it's not necessarily all pandemic related. Hotel was having troubles even before the pandemic. We're here in New York, close to Times Square, and the 20 Times Square project went belly up in 2019. Shortly thereafter, I was in Seoul and visiting with a number of investment managers in Seoul, and everybody there was asking me about Times Square and about the hotel market because they all knew that one person who in Korea who had made a loan on the buildings. And so it's like every other real estate market, everybody wants to gossip about what the other person did. But so the market had the problem then, and it had a problem because we had an oversupply of new brands coming into the market, so there was an excess of rooms, plus disruptive competition from the likes of Airbnb and VRBO. So all that was coming through at once, and transaction activity was drying up. And then the pandemic comes along, and it's just kicking a man while he's down. So lenders pull back more there than any place else. But again, too, some of it is just structural. The CMBS market was always a popular source of financing for hotels, and they had a harder time stepping into this kind of stuff. But other than that, the other sectors, apartment and industrial, in line with the deal volume. It's a record number of originators active there. But all these pricing issues, it comes up against a theme that's been huge in the capital raising world, which is raising money for distressed funds. And we just really haven't seen much. I'm looking here at distressed asset sales, and that's the orange, just the dollar volume levels, and the blues is a percent of total sales, and we just haven't seen much so far. Now, some of it might be a timing issue. You look at all the way back to 2007, December 2007 was the start of the financial crisis, and we could see that as a percent of total sales, distress, it took until 2010 before it got above the 15% level. 2020, we started in the second quarter. We're not nearly as long at this point as before, but even then, you had some increases in 2009 of distressed asset sales. It's just not happening as much today. And again, part of it is the fact that we went in from a better position. We didn't go in highly leveraged like before. And so you just didn't have the susceptibility to distressed situations as before. There's a lot of people that were raising money saying they're going to buy distressed assets. It's going to be just like that last downturn. And I just don't think they're going to be as successful because there's just not as many distressed assets. There are some. They're mostly in the hotel market and the retail market. There's going to be some office buildings. But it's long-term structural issues that these buildings face. It's not the kind of just temporary, buy the lower value, wait for the economy to recover, refill the debt portion of the capital stack and walk away with some asset appreciation. I think the people who are going to be more successful with these distressed assets that do come to market are the folks who can come in and take care of fundamentally broken properties. Take a mall built in suburban Cleveland in the 1970s to sell polyester pants to construction workers and manufacturing workers and turn it into something new. That's a hard thing to do. That's not something that's an issue of financial engineering like the successful funds did after the financial crisis. That's someone who can get their hands dirty with construction issues and work to get entitlements to change the fundamental use of the space. In conclusion, my big story here is that not every downturn is the same. This is a chart I've been using to highlight that fact over a number of presentations over the last year. And I'm looking at price trends relative to recessions all the way back to the 1950s. Now, RCA was not around in the 1950s. Our founder wasn't even born then. I wasn't either. But there were some predecessor surveys that were done. And so I took some data from the Fed that was online that took some of those predecessor surveys and spliced it onto our price trend. The orange lines are recessions. And you can see a number of recessions, commercial property prices actually grew. We had some really harsh recessions in the 1970s where prices did great because they were inflation driven and people wanted to pile money into real estate because it was a protector of asset value at the time. The two recessions that saw double-digit declines in prices, it was the early 90s downturn and it was the global financial crisis. I don't have a price series that goes that far back, but there's some evidence that shows that the other one that we saw that had double-digit price declines was the Great Depression, that the recessions in between there didn't see the same kind of price declines. What they all had in common, again, it was a disappearance of debt. If you see 60% of the capital stack go away, you're going to have a bad time. And that is what is different this time. We don't have that collapse. There are fundamental challenges. There's going to be repositioning of properties. There's going to be a realignment of what the income looks like and how people use space. But that will lead to a more muted price response than we saw last time through. So with that, there's my contact information if you have further questions on all this. But I see your phone, you keep getting bing,
yes,
bing, bing.
We have so many questions, and I have so many questions. And
so do your thing.
Yes, I'll start with...
This is my most fun, this is the part I enjoy the most. In some sense, I almost prefer a situation where it's just questions and no slides, but it's hard to do those.
Good, next time we'll start with Q&A. Right? We'll just skip this whole presentation. Great, we have a lot of questions, and please keep sending them. And for our audience here, feel free to just ask a question. I'll start with the COVID question, right? The elephant in the room, Delta. And maybe we in the New York don't feel the pressure, but COVID cases are rising sharply in Texas, in Florida, those cities, those markets with the Sunbelt markets that are keep attracting capital flows. But do you see Delta being a problem or a potential risk to the market strength there? Are they resilient to the next COVID resurgence?
Well, it's tricky. I'm not a doctor, right? Throughout I saw a funny joke online that all the folks who suddenly became epidemiologists are now becoming experts in foreign policy relative to Afghanistan. So there's certain opinions you can look at, and others that you have to be suspicious of. Opinions on it are varied, and so that's why I think you really got to look at the data. And on the investment sales side, it's too high a frequency of a shock to see any impact yet from COVID, from the Delta variant on the investment sales side. We're publishing our figures in July next week, and in July people weren't really talking about Delta all that much yet. Mm-hmm. So it's when it does have an impact, I think it's going to be more of a third quarter kind of thing. I did see a report from Goldman Sachs this morning showing that there's a little bit of a pullback in consumer optimism in July. Yep. that came from all that, and so there might be some changes at the fundamental level that comes through on that, but it was relatively small. It wasn't a huge pullback, and we're still at healthy levels of consumer activity. If it drags out over many months and many months of trauma and no beds and no cures, and it continues to spike, maybe then it would start to impinge on the real economy, especially if there are more lockdowns. The thing that I'm hopeful for is that some more rationality comes through. We have seen in the data, there's been a lot of reports that when all that negativity came around the Delta variant, the more people woke up and said, yeah, maybe I should go get my vaccine. And hopefully that's the reaction that we get from that, that more people just realize they got to do their part. And that's the best case outcome, I hope.
Exactly. And I can echo that. Just based on CBRE's data, we have our activity trackers internally, just seeing how investment increase, and decrease. And just based on the data we've seen, there hasn't been any influence of Delta in the investment flows. Hopefully that will continue, but obviously there are different sectors that will be influenced differently, such as the consumer sector. So we'll keep watching it. I think that's right. The safe way to say it. But back on office, it has been a heated debate since the beginning of the pandemic, because people have the opportunity to work from home. Maybe some people got used to working from home at this point. And I know RCA has been bought by MICI. I heard MICI has been testing with this idea of hybrid office model.
Yeah.
What's your view on that?
The CEO of MICI wrote a piece just recently talking about work from home is a new reality. And I think and one of his points, I think, really gets at the heart of the problem, of the question, rather. His point was that a well-managed company doesn't need a 19th century business model of everybody coming into the same place to work. A well-managed company will just hire the right people, incentivize them properly, and make sure they're engaged, and then you don't have to watch them. The thought of having office workers someplace so you can watch them, that's problematic, because that shows you've got workers that you can't trust. And if you trust the folks you work with, and if they're engaged, it doesn't matter where they are in a sense. Now, it doesn't matter where they are in a sense, but there are needs to be around other people. And so there's going to be a mix of uses. If it wasn't for COVID, I think we would have continued to see much more suburban activity, just as firms tried to chase those workers, those millennials, as they age out of cities and move into the suburbs. And I'm a little bit worried about suburban office stuff because if I'm moving to the suburbs, okay, but maybe I have that big home and I have a home office, and so maybe moving to the suburbs doesn't create that demand for suburban offices as it had in previous decades. But it also points to, I mentioned the millennials as part of the labor force, but they're not the only part of the labor force. And that's another problem I think a lot of folks have had with the analysis of the office market. They think of all office workers as the same, as if everybody's going to work from home. That's great for these senior executives who have the house off in the Hamptons, as well as the big place in Westchester. But think about the Gen Z workers, the folks in their 20s, just a few years out of college. A lot of them left the city and they went to live with their parents for a while, but they're starting to move back into the city. You can't get a date living in your parents' basement, and so they're back, but they're not in a place where they can afford to have that extra room to use as just an office. So that changes things. To them, maybe they want the office because they need a place to work that's a little bit different, and so maybe there's some issues there. Then there's also just labor issues in terms of the activity. Salespeople hobnobbing in with everybody. The folks in the past who have gone and hung out at the 21 Club at the bar to kind of figure out who's doing the next deal. Although I don't know where they're going to go now that the 21 Club is closed. So the city's going to have to reinvent itself. But those folks, maybe they need the office just as a place to be, where the office becomes a little bit more of a clubhouse for some of those folks to kind of hang out, talk to each other, share ideas, and but then if they're going to be there, you need some support staff. So it's going to start to change how it looks. I think there's going to be a lot of business for folks in that like the corporate real estate world, like some folks over there that I used to work with at CB in the corporate side. The designers, like the folks at Gensler, they're going to have a ton of work as they reimagine spaces and think about how they're redesigned. But there is that fundamental need for people to cluster for some activity. So I don't think it all goes away. But I'm wondering how much of it was that clustering in suburban areas as opposed to clustering in cities. Because if you are in a place like LA and you need to get together with a group of folks, one person's in Century City, another person's in Orange County, it's just hard to get together. That's more of a central location kind of thing. So suburban areas may not be poised as well in that sense. So, and it runs counter to where the pricing's at the moment, but I think some of the pricing issues more of a Sun Belt versus the expensive Northeast kind of location. So the office market, the challenge I think is that it's a nuanced issue. It's not sort of all office workers are the same and all office workers can be at home. There's need even for the highly motivated folks who will work on a plane or work in an office or work at home. There's still a need for those folks to be together with other folks at times, and there are a variety of needs there. And so I think that it's going to evolve, but I think we will still see some sort of demand for offices.
Yeah, I would add that about this time last year, I read a New York Times article. It says that working from home is a privilege of intelligent workers. So even for a lot of service workers or workers in other industries, maybe working from home isn't an ideal condition for them, right? We haven't think about that too much because maybe as researchers, we had the privilege and we had the opportunity to work from home, but it doesn't work for everybody. And it's important to notice that there are businesses that run on people and people's activity, people's interaction. So it's not always a given that people's connection cannot be easily built virtually. Having this face-to-face conversation today kind of proves that point. It's important to have people around. If Jim and I sit here just talking to air, I think it'll be a lot more boring and less fun.
Someone will look at us and think, "Wow, they're crazy."
Yeah, we appreciate you being here. All right, we have. Do we have any questions from the audience here?
Right.
Is really difference between different downturn, 2008 and Great Depression, either the 1970s, the oil crisis. So it's all different. So my question is, I saw the indicators in the
And I'm going to restate your question so the folks, listening online can hear a question. And so tell me if I kind of get the thrust of your question right. Sort of, every downturn is different, but there were, even going into the downturn, there were some indicators that there were some challenges, like the inversion of the yield curve that happened in 2019. Do we see new types of things moving forward that might be indicators of problems for the economy? It's sort of kind of a rough description. Yeah, and again, not everything is COVID. Go back to 2019. It's the same story I was talking about earlier for 2019, that there were some concerns in places like San Francisco that this blitz scaling philosophy that had been out there in the business world, that maybe that had played out, that there was no more growth in that blitz scaling approach, where firms tried to get big before they got profitable. The inversion of the yield curve. I remember being at conferences in the fall of 2019 where that was all the discussion, that we're going to have a recession, the yield curve is inverting. I want to move into asset classes that are CapEx light because I want to make sure that I have capital, I have an ability to redirect the income that's coming from the buildings into my funds, as opposed to just keeping this asset up and going during the downturn. So even then, there was more of a focus on the industrial and apartment sector because they're CapEx light. Moving forward, I think that CapEx issue continues to be important, especially because there's going to be other costs that come from this. We will get back to some sort of office use. It won't be the same. It'll be different, but there'll be some sort of needs for it. But I mentioned Gensler. Gensler means money. Yeah, because you're talking redesigning buildings, redesigning spaces. That means CapEx. Who's paying for that? Who's paying for the new HVAC systems? Who's paying for the other CapEx things that make it work? So that's a problem, I think, for the office market moving forward, especially if before the recession people were worried about being in CapEx light investments. Now suddenly you've told me that I have a higher CapEx spend needed on that asset. So potential buyers are still going to be cautious for some time because of those issues alone. But there's an even bigger CapEx issue I don't think any of them are really thinking about yet, that they should be. Well, actually, I should rephrase that. They are starting to think about it, but it's the environmental costs in terms of the CapEx that's needed for making sure that the next hurricane that hits New York, that my building is protected, and there will be another hurricane that hits here. The CapEx around what I have to do to keep my buildings in South Florida from flooding in the next hurricane that hits there. Miami Beach, every day now, there's stories of flooding, even in a bright sunny day. Just the sea level has changed enough where even roads just flood out every day, just as the water comes up through the coral down below. But there's going to have to be a tremendous CapEx spending for some of these assets, and that's one that I don't think everybody has fully quantified yet. And so that's one that bears watching moving forward. And that it's not going to be a recession necessarily that drives some of that. Maybe some regional recessions if you have some environmental disasters that displace people for a bit. But certainly something that's going to change sort of the income characteristics of buildings as people have to spend more than income to keep the buildings going.
Can I just add one thing? It's perfect timing to promote an upcoming piece that CBRE and MSCI are collaborating on. So we, CBRE, and
really?
The climate...
This is new to me.
The climate value at risk data series that MSCI purchased recently are collaborating. We're going to release a paper on top 10 things an investor should know about ESG. And in that,
I'll have to talk to you afterwards to see who's doing it. I mean, we're still getting to know everybody, and so I got to see who you're working with.
Yeah, that's a great team, and I'm a fan of that data series at MSCI. And in it, we're going to include a list of top global cities and with the value at risk. That is the financial cost on your portfolio if you don't take environmental risk seriously. In New York, for example, I'm just going to say it's 6%. If you don't if you're not proactive about protecting your asset against climate events, you will lose 6%, or you will have to spend 6% of the value to go through the loss, basically.
Yeah, to mitigate some of the challenges you face from environmental changes.
Exactly. So yeah, we can talk about that after this call, but please pay, it's coming in September, I think, if not early October, and it's going to be highlighted on our marketing campaign. Please stay tuned. It's a paper I'm really happy about, and again, I'm really glad we can work with MSA on this. Perfect. There are other questions on the online on YouTube. We received a lot of questions on alternatives.
Oh, okay.
So Jennifer Song is asking about senior housing. She saw that the construction was down significantly. And can you elaborate a bit more? And then Mingja asked about single-family rental. So we're seeing this, some alternative sectors suffered during the COVID, and some sectors received a boost from COVID. So these are perfect examples. So can you talk to us a bit more on these alternative sectors?
Sure. The everything with senior housing has been a bit up in the air. The senior housing was one of the sectors that early on had a lot of people worried and concerned because so much of the early problems in the crisis were seen in nursing homes and just horrific scenes of people passing away from the virus. And so there's a lot of uncertainty about what happens next with those properties. There were a lot of mitigation efforts that went into keeping those properties going and protecting the residents. It's been stressful for a lot of folks. I have family members myself who talk about how they can't go see their mom now because she's stuck in a place that to lock it down to make sure everybody's protected. They've just not allowed outsiders in. And there was some capex that had to go into that, building new rooms where people can kind of go in on one side and all the air is not the same as like on the other side of the glass, almost like being in a prison. And so that's psychologically difficult for everybody involved. So you face that and you might think that, oh, well, maybe there's distress there. But there wasn't. I mean, if we look across the distress that we've seen, there's very minimal levels of distress across everything. Seniors housing and care are still very minimal levels of distress. Even though you've seen challenges for some fundamentals, it just hasn't come through the same way as that last downturn. There wasn't enough of a shock to bring those income fundamentals down far enough to lead to massive defaults. Part of it is just demographic need is there, and they did act quickly to try and mitigate some of the challenges that they had from the virus. So I don't think that the pandemic does away with those property types. There's still that demographic need. It is going to be different. There's going to be more limits on sort of who can come in. I just hope to hell that everybody still remembers to wash their hands after this. That's something that this pandemic, maybe it gives everybody some better behavior. Now, with respect to single-family residential, we don't have good stats on that ourselves. It's a sector that it's a more disaggregated sector. It's not like tracking an office building in Manhattan. You can see that once one investor came in and bought it, it's people buying dozens of buildings at a time and kind of bringing them together into a portfolio. Those folks, it's just harder to keep track of it. But it's a sector that it's getting into the popular business press just because there's so much growth in prices for single-family homes, and you see people just looking at the high-level numbers that that some groups are now funded by hedge funds and buying up some of these buildings. There's a lot of nonsense that's flying around out there that home prices are going up because of these folks. Home prices are going up simply because we can't build enough. We don't have the labor force. After the financial crisis, a lot of folks left the construction industry and never came back because they lost jobs in that and they just went into other things. And then the dirty secret in the U.S. economy was that in the financial crisis, in the housing boom before the financial crisis, about 10% of that labor was undocumented migrants from Ireland, from Mexico. Where I used to live in Boston, you go down to the field. It's a bar in Central Square in Cambridge. Lunchtime would just be filled with all these families from Ireland that were working in the construction business, coming in and treating it like the local Irish pub for lunch. They're all gone now because they were working there for cash, and they're just not there on the market anymore. So we have very limited labor, and then you have material costs as well. And then the kicker on top of it all is that the regulatory environment around construction has become much more problematic. So it's hard to build anything, even if you have the materials, even if you have the labor. So it's just hard to build anything today as well. So that combination, there's a lot of money moving into apartments and moving into single-family residential. And I view it almost as a macro bet on ongoing NIMBYism, limiting construction activity. If you want more housing built, if you want lower prices for it all, just don't get in the way of developers. You do need some regulations around construction standards in terms of what materials are used and everything. But it shouldn't take, there's great stories of someone trying to build affordable apartments in San Francisco, taking more than 10 years to get all the permits they needed just because of all the busybodies in the local community boards. That hampers these cities.
Excellent.
What else we got?
I think we have time for one more question, and that has to go to...
I wanted to hear your thoughts or shed some light or show some love to like what I feel like is the ugly duckling, but like retail. Specifically here or at least I guess speak the most about New York, but like what do you think is going to happen in retail in general? Like the difference between Soho, Fifth Avenue, or maybe like Madison on the Upper East, and is what's going to happen to it, or are there like specific tenants? Is everything going to be what's the difference between a Target moving in versus like what's happening to like the bodegas where you get your like chopped cheeses, because they all seem to be shuttering quicker than most.
Okay, well, retail, I want to address this in two levels. One, I want to talk about retail broadly, nationally, and I'll get into some New York specific stuff that's probably, some of it's probably, you're not the only one that's New York centric. There's going to be a lot of folks online that are going to be more New York centric. But nationally, most of the retail market is not like New York, where it's the city and you walk up to things. It's car focused, and there's a lot of negativity in retail with people talking about these big old dead malls. I mean, it's so bad for the retail world in those places that the ICSC actually changed their name to take out shopping centers out of the name. I mean, that's a marketing signal, if anything. But it's not the same everywhere. There are some good malls still. There's some fortress malls that still have high-end tenants and some foot traffic. But things are different. A few years back, there was a lot of aspirational spending, and although psychographic kind of stuff that people do shows that aspirational spending, I've got to have the newest Louis Vuitton bag that or whatever the brands are. Some of that's changing. I've got some friends in the fashion world here in New York, and they talk about how the business of what they're selling is different than it was just a few years ago in terms of the quality of the materials and content. So there's less of that high end for some of that on the one hand. But there is a bit of a narrowing of the income profile for the United States for the middle class. You used to have a very wide, broad middle class, and so you saw an expansion in the 60s, 70s, 80s in malls to kind of service that middle class in middle America, and where they bought their shoes and pants and everything at malls in these industrial areas. As we deindustrialized those areas, that middle class shrank, and there just wasn't the need for the Weebolts, the Montgomery Wards, the Dillards anymore, these kind of mall anchor tenants. So you saw that shrink. And that's where the real problem is in those malls. The stuff where someone has some daily needs, they go to the Target, they go to the Piggly Wiggly, they go to the Duane Reade, the Walgreens. Those places, where it's focused on the more consumer end, sort of the daily needs end, there's still some life there. And so you're seeing asset sales continue at a healthier pace in those types of assets. It's just the bigger stuff where it's more the discretionary spending and the changing patterns of the local workforce where there's a problem. But then we were oversupplied in that stuff as well. We built way too much of it in the 70s and 80s. The United States, compared to every other country in the world, we are far more over-retailed than other countries. You just have more square feet per capita than other countries. And so some of that just has to die. Now, with respect to New York, it's a different market. It's more of a pedestrian-friendly market compared to these other places. You had problems that were happening in retail even before COVID. My office is in Union Square, off of Fifth Avenue down by there, and there was a restaurant that I just loved. Actually, two restaurants I just loved right next to each other. Coffee shop. It was a little diner place. It was just they made this duck hash frittata that was just fabulous for breakfast. Horrible for your heart, but fabulous. And they had been there early on when Union Square, as the city was recovering in the 80s, it became sort of a go-to place. Blue Water Cafe was next door. It was a fish restaurant, and they're both gone now because rents went up dramatically in the area, and it kind of shut down those retailers, and other things came in. But in the most recent economic expansion, a lot of folks bought as they saw growing rents in the city, and they underwrote acquisitions where they figured that rent growth would continue. And so they bought the buildings, they moved some of the older tenants out, thinking that they could just continue to ride that rent growth wave. Then rent growth stalled. So you've got some of these spaces that, even before the pandemic, had some challenges. And then the pandemic hit, and Soho was boarded up for a long period of time. There's more life in those areas now. On the weekends, some of those areas, Soho is just, in some sense, I feel, dangerous on the weekends now because it's so crowded. And dangerous in the sense of too many people on the sidewalk, and they should probably close down car traffic to the area so that nobody gets hit by a car. It's just, I have fear for some of these people walking through the areas. Make it a giant pedestrian mall. So you have some areas where there's some foot traffic coming back, but it's more people coming into the city, see their friends, go to restaurants, more experiential stuff as opposed to shopping. I think that might be some of the savior for some of the stuff moving forward. You don't have the same kind of income distribution at times to do all the aspirational shopping as in the past. And so I think that limits some of the upside for kind of repopulating some of the shops. But then there were some buyers that came in thinking that the rent growth would continue at the double-digit rates for retail. They've been able to finance their ways out of it for a while, but at some point the bill comes due on that. I think there's some other problems where we've seen new development. There came to be a period of time where, not just New York, but every urban area in the United States, the city planners and city leaders mandated a lot of ground floor retail when people were redeveloping stuff to be kind of towers. And not all of it's needed. You see all these designs that the developers put together of, the charrettes of, here's all these people walking around and that they're at cafes and they're going to a shop nearby. But there's a lot more of that space that was built than is actually needed. And so where I live in downtown Brooklyn, there's a number of new buildings that have empty space and just signs up from the leasing agents, trying to get someone in there. And they're going to have to be creative. The mall underneath my building, they've actually taken some of the empty space and they've turned it over to an aerialist troupe, which it gets some people in the door because it's fun to watch, but it can't really pay the rents. So there are some challenges there too from oversupply.
If I can add my 2 cents,
Please.
Just based on the data I've seen,
Yeah.
the retail leasing has been picking up.
That's good.
Which is very positive and similar in investment. Cap rate expansion, which has expanded since 2018, and right now it has reached a stabilizing point because we're seeing the expansion slows down and maybe the retail yield will finally stay at a relatively reasonable level. I think it's a pricing issue. Right? If you are looking for the best corner on Fifth Ave and pay $4,000 a feet, right now it's too expensive. But when the price drops and drops and drops, it's at $2,000, somebody will think about it. Right? Similar in investment. If they think the price is good, or if they think this is a deal, the investors will pay for it. And we still need retail. American consumers just love spending. I think in some sense, the developers or the owner-operators in the retail space is very spoiled because American consumer just keep spending no matter what. But in other areas, in Asia-Pacific or in Europe, this idea of placemaking or experience-driven retail has been around for ages. They have to do it, right? Because online shopping became popular and they have to face this challenge. It's the similar thing in the US. I think the world is just getting to know retail from a different angle. And it's a good story in some sense. We're going to see some cool stuff in the retail space, I think, in architecture or just idea or design perspective. We're going to see some creative things. So I'm looking forward to that. Great. I think we'll wrap up here. Thank you for all the viewers on YouTube, and thank you for your questions. And special thanks to everybody who came here. You're special to us.
And thank you, Charlie, for organizing this.
Yes, thank you, Sandstone and CRE, and biggest thanks to Jim Costello, who has been awesome as always.
Thank you for organizing too.
Great. Well, have a good night, everybody. Hope you enjoy the rest of your day and stay safe. If you haven't got vaccinated, please do. It's very important that we're all, contributing to the health.
Anybody who gets vaccinated
society.
is helping our industry. So
Exactly.
do it.
Do it. Great. Should I just close the YouTube?
I'll let him touch it because
Well-
I caused so many problems with it earlier.
Well, thank you.